Gold is crashing hard right now, and global markets have shifted into full panic mode. Meanwhile, the mainstream media is spreading fear, telling investors that the gold rally is officially over. But is it? Look, I'm not going to tease you with the answers. I'm just going to tell you exactly what's going on right now, and then you can decide if you want to stick around for the next 5 minutes to hear my thoughts on it. So, first, Wall Street's systematic trading algorithms are automatically liquidating billions in paper gold contracts because a massive spike in oil prices just terrified the bond market. Second, the cynical observer would say this is a deliberate liquidity flush designed to wipe out late to the party retail investors who piled in with massive leverage allegedly. And third, the actual physical demand for gold from commercial and central banks hasn't dropped. In fact, it's up because vaults are emptying at record rates. Oh, and a bonus fourth reason. After a rally as big as the one we've had over the last year, a pullback is normal. Anyway, my name's Nick. I've been a professional investor. I'm a professional trader for 24 years. Before I start, I'm not a financial advisor, and this is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube, especially one wearing a shirt that says bloody allegedly on it. I mean, anyway, let's figure this out together. Right now, the media is saying that the gold run is over, right? They point out that PPI came out at 3.4% for February, just, like an hour or so ago, which was way hotter than expected. And they claim that because inflation is being sticky, the Federal Reserve is going to be forced to hold interest rates higher for much longer than anyone thought. And when the interest rates stay high, the US dollar index spikes back to over like a 100, right? Which supposedly makes non-yielding assets like gold completely worthless. And if you don't know what the dollar index is, it's the value of the US dollar, right? It's the strength of the US dollar. They want you to believe that the macroeconomic environment has fundamentally shifted and that you need to sell your gold immediately before it drops even further. Allegedly, that's what they want you to believe. The cynical observer would argue that this is complete nonsense. Over the short term, sure, the paper price is dropping, but structurally it could be a massive lie. But here's the catch. The media always forgets to mention stuff like this. Heading into 2026, gold was universally recognized as one of the most crowded trades on the entire planet. After gold shot up over 60% last year, a massive wave of retail euphoria flooded the market. Inexperienced investors piled into highly leveraged exchange-traded funds ETFs, essentially renting gold for quick momentum, right? They weren't actually buying gold, they were renting gold, trying to make money from it. And Wall Street loves it when retail uses leverage because it sets up a perfect trap for them. So let's talk about why we had this violent crash today and what is happening right now. So when the conflict in Iran escalated and the Strait of Hormuz effectively shut down crude oil spying past $100 a barrel, that energy shock terrified the bond market, pushing the 10-year yield up to almost, I think it was 1.8% if I remember, but I'm doing that from memory. And the second those yields ticked up, the commodity trading advisors, the massive systematic, rather hedge funds that control the market triggered their preset stop losses. Now, I'm going to explain what a systematic hedge fund is. It's a hedge fund that just follows a system, an algorithm, right? They don't have real traders making real decisions. It's just based on algo, and it's very predictable because they just do what the algo says. Anyway, these funds operate on algorithms that don't care about geopolitical safety or physical supply. So when their momentum models break, they automatically dump tens of thousands of paper gold contracts onto the market in a matter of seconds. The initial wave of mechanical selling knocks the price down through obvious support levels, which then triggers all of the margin calls for those leveraged retail investors. This isn't just happening to gold, by the way. To a lesser extent, it happened to stocks today, and we've seen billions and billions and billions over the last few weeks of systematic hedge funds, say, selling stocks, right? And this creates a devastating self-fulfilling spiral of forced liquidations. They're dumping paper trash to drive the spot price into the ground while they scoop up the underlying assets for cheap. Allegedly, This exact same setup happens every single time we hit a period of stagflationary panic. Look at what happened during the 2008 financial crisis. Gold suffered like a massive 30-35% something like that correction as institutions desperately liquidated their paper assets to raise cash to cover their other bad debts. They flushed the market, shook out the weak hands, and then gold went to hit record highs for like over 3 years, right? The underlying mechanism today is exactly the same. While paper market is experiencing a violent reset, the physical market is telling a completely different story. Central banks bought 863 tons of actual physical gold last year. I know that doesn't matter this year, but this year they're projected to buy another 800 tons, and that's unlikely to change. And some are also saying 1,000 tons rather. So countries like China, Poland, and Uzbekistan aggressively hoarding real gold to protect themselves from a U.S. national debt crisis with the $40 trillion in debt that they're almost at. So they're perfectly happy to let Western institutions suppress the paper price because it just allows them to buy physical Medway at a discount. And if you want proof that this disconnect is real, just look at COMEX registered vaults right now. Registered gold is the actual physical metal that has that people who hold futures contracts on COMEX is the actual physical metal that they can claim for themselves. Right. Last April, those registries, those registered inventories were sitting at a record peak of 24.25 million ounces. Today, that number has plunged to roughly 16.7 million ounces. It is dumping at an unprecedented rate. This is a 31% collapse in the deliverable physical supply in less than a year. So they buy cheap paper contracts, demand physical delivery through the exchange, and quietly remove the metal from the Western banking system entirely. That's what's happening right now. And it's similar to what was happening with silver also. So when the registered vaults run low, the risk of failure to deliver skyrockets. If a geopolitical shock trick is a massive run on the exchange and everyone demands their metal at once, then COMEX won't have registered inventories to satisfy those claims. This is just going to force cash settlements, and they're effectively paying you out in depreciating dollars while they keep hold of the hard assets. It's a wealth extraction machine, allegedly. The truth is this isn't a verdict on gold as a long-term hedge. What's happening today? It's a violent mechanical reset of an overcrowded leverage trade, meeting a wall of profit taking. So what does this mean for us? Look, my plan's exactly the same as it's always been. I don't care about these short-term moves up or down. It doesn't really matter to me. I'm sitting on my hands through all this volatility. I said at the start of this war, I'm sitting on my hands and I'm not taking many actions, right? I'm avoiding Wall Street leverage traps entirely, and I just stick to physical hard assets that I can actually hold in my hands. And who cares if price goes up or down a little bit. As long as I'm not in leverage trades, I don't really care. Anyway, that's my opinion. My strategy is simple. Ignore the short-term noise and stay focused on the long-term game. So what do you think? Are you seeing this drop as an opportunity or a trap? Let me know in the comments.